What I'm going to talk about is simply how we look at the global economy at the moment, and then make a translation to how we look at markets currently. We publish a quarterly publication which we give a different title every quarter, and the one that we only recently finished is called Rebuilding Confidence. When I look back 6 months ago, I was here in November, and it was a pretty bad situation. Pessimism was all around. The euro crisis was threatening to completely go out of hand. The policymakers in Europe were in serious danger, I think, of completely dropping the ball. People were talking about the euro, and they were saying that the euro, maybe it had only weeks left, and then it would collapse altogether. The global economy was slowing, and people started comparing the situation then to what happened following the collapse of Lehman Brothers in 2008. And we know what happened after that. We went into a very, very, very deep recession. So it wasn't great at all 6 months ago. But here we are at the end of March. Not only is the sun shining, but the economic circumstances have also changed rather dramatically, I would think. And the question is, why did this happen? Why did we not have a sort of a duplication of the post-Lehman debacle? Why did we not have that? I think there's a number of reasons why we didn't have it. First of all, which actually not on my slide here, is I think companies in 2008, they were completely unprepared, and they had inventory levels that were way too high. And then when the economy hit a stumbling block, all companies were forced to sharply reduce their inventories. And in order to do that, they basically all sharply reduced production levels, and that fed on itself, and you get a very nasty, vicious circle. This time around, I think companies were much better prepared. They were in a stronger position, and they were more alert to what was happening, and therefore their reaction wasn't as dramatic as it was back in 2008. Perhaps even more important, but related, I think, the financial system did not dry up. Back in 2008, the financial system completely seized up, and companies discovered that suddenly they had no access to funding. And if you have no access to funding, then of course you basically have to stop living, which is what happened. This time around, for a number of reasons, the financial system didn't dry up. And when companies experienced that, they realized, well, it's not as bad as it was in 2008. And they had already responded. So in fact, when it wasn't so bad, we actually got sort of a reverse development. We actually got, over the last couple of months, we got a rather meaningful acceleration of global economic activity. If you look at the industrial sector, which is the most cyclical sector of the economy, industrial production globally has grown over the last 3 months at an annualized pace of 8% or even higher. Now that won't last, because demand in the world isn't growing at an 8% pace. This is what we have, and this is good. Production growth will slow, I think, but at least we did not have this terrible collapse. Related, of course, also the European leaders, after all these summits where they basically did stupid things. In December they had another summit, and which was a great summit, largely because they didn't do stupid things, which was a big change. And then of course the ECB stepped in, and I'll talk about that in a second or so. When you look at economic indicators, which is what economists do, unfortunately, business confidence is one of the best indicators to look at if you want to follow what's going on in the global economy. This is business confidence for the Eurozone, and for the US is a pretty similar parallel development. Where you can see we had a complete disaster, complete breakdown in 2008, 2009, and had quite a nice recovery in 2010. And then in the course of 2011, it started weakening again, and we were threatening to go into into a development similar to 2008 and 2009, but that actually didn't materialize. Towards the end of the year, this thing found a bottom, and then it started rising. The most recent readings are a little bit lower again, but there is always a little bit of short-term volatility in these sort of indicators, and the level that we're at is actually quite okay. In emerging economies, you have a pretty similar picture. I'm showing here Brazil, China, and India, partly to hide a little bit China, because China's business confidence is not all that great, but certainly in Brazil and in India, things seem to be improving, at least in the industrial sector. And because these economies have large industrial sectors, much larger than our sort of economies, and certainly much larger than the Jersey economy, of course, business confidence in the industrial sector is quite important. So the global economy seems to be improving. It's not fantastic. By no means is this fantastic, but growth has recovered, and we have a pace of growth in the world that is, that's okay. Not fantastic, okay, and that's better than a disaster. When you look at different economic blocks, one thing that strikes me is there's big differences between the different economic blocks. So one indicator to look at, for example, is unemployment in different countries. And this is a very simple graph, of course. Unemployment in the US is on a declining trend, and in fact, over the last 6 months, it has declined quite a bit, and it has surprised most people, including ourselves. But we think that this is a real improvement in the US labor market. For the Eurozone as a whole, unfortunately, unemployment is trending higher. The question, of course, has to be why is the US doing so much better than the Eurozone? The answer, I think, is fairly straightforward. The governments in the Eurozone are pursuing much more austerity policies than the US. They'll still have to do that, but that'll probably have to wait until after the elections in November. There's one reason. Another reason is the Americans were much more forceful in sorting out their banking problems. So their banks are stronger than Eurozone banks. And I think the credit mechanism in the Eurozone is still severely stressed. And of course, if there is a problem with the credit supply to an economy, which I think is the case currently in Europe, then economic growth is going to be suffocated. And the result of that is rising unemployment. And maybe a last factor to mention is that confidence in the Eurozone is damaged much more than confidence in the US because of this euro crisis that we have and that we always talk about. And of course that also affects the US, but not to the same degree. And another big difference actually is if you look at money growth. This is sort of a bit technical, and economists like to look at these things, and most people don't look at money growth. They make assumptions about money growth. Most people think the European Central Bank is creating a lot of money, it's printing a lot of money. Yet if you look at the actual stock of money out there, well, in Europe it's hardly growing. We can discuss why that is the case, but the difference with the US is remarkable. Money growth in the US has accelerated quite sharply and is actually currently quite strong. Now, if money growth is very strong, ultimately there are inflation dangers, and a central bank is of course charged with keeping inflation under control. So to me it looks like, wow, the US is ahead of us, and they may have to do something about this strong money growth. The problem is the Federal Reserve, the central bank in the US, has promised the markets that it will not, or that it, let me phrase it correctly, that it will keep interest rates at very low levels at least until the end of 2014. Now, to be honest with you, I don't know about you, but I promise my family, I promise my wife things, but I'm going to be very careful promising things, out to 2014, because the chance that I may not be able to deliver is quite significant. Yet the Federal Reserve has done that, and I think now they have Now, they may face a problem that they may have to break that promise. And I can tell you, if you break promises, you can be in trouble. Many markets actually don't like interest rate increases. Of course, if you have interest rates as low as where they are, official rates, the only way effectively is for them to go up, and it must happen eventually. The big question is whether markets will take it particularly well. Personally, I think they will have to do something sooner than they were planning, and but I think they will do that extremely carefully. When you talk about differences between different economies, the same can be said within Europe, and I have some really simple numbers for you. Car sales, which I always like to look at car sales because, well, I sort of like cars, and I understand these things. It's simple enough for me to understand. All this shows is car sales in the month of February this year compared to a year earlier. And when I looked at the numbers, I thought, hey, there's a great story here, because the countries that are pursuing very severe austerity policies, they have the weakest car sales. Basically, car sales in Portugal and Greece have more or less halved from a year ago, and a year ago they were already depressed. So this is not good news. With this one simple number, that Portugal and Greece are in trouble still, from a cyclical point of view. Then you have a group of countries, let's say starting from Ireland to the UK, where you have varying degrees of austerity, and car sales are still declining, so the demand for cars is still falling. Then you have Germany, which obviously is the, let's say, the relative powerhouse in Europe, where car sales are unchanged. But I'm always looking for positives, and I found them in these numbers in Estonia and in Iceland. I think there's a great story, because these are countries that that have gone through a very, very severe contraction in economic activity, more so than most other European countries. Of course, Estonia is part of the Eurozone. Iceland, of course, is not even part of the European Union. But both countries, both economies have gone through a very severe period of contraction and are now recovering. And of course, I realize, the Icelandic number here looks particularly impressive, but you have to realize that in the crisis, Icelandic car sales fell something like 95%. So if you have 100 in car sales and then you fall 95%, you're at 5, then of course, if you go back to 12.5, you get these sort of numbers. But you're still 80-something% off the peak. But nevertheless, we have to look forward, and what's happening in these countries is these economies are recovering from a terrible base, but they are recovering. It shows that they've gone through a process, and there is actually light at the end of the tunnel of such a process. That would be my message. Many countries in Europe are going through a very similar process, and you have a lot of economists and commentators saying, this cannot work. This will only lead to depression. Well, Iceland and Estonia show that there is actually light at the end of the tunnel. Now, another worry that people have is China. China is a dominant economy globally. It has grown very rapidly in recent years, actually in recent decades, over the last couple of years, 8 to 9% growth, sometimes even higher. And now they're talking about slower growth, and people discuss whether China is going to have a hard landing or a soft landing, and if, suggesting that it's going to land. These high growth rates are a thing of the past. We're going to move to lower growth rates. The question, of course, is, does that really matter? Well, when you look at car sales, as I was talking about car sales anyway, probably appropriate to look at these Chinese car sales. It seems to me, this is not that convincing, really. I realize that, but when I look at all the data that we get from the Chinese economy, the conclusion that I draw is China is in the process of a soft landing. It'll move to a growth rate of maybe 7% or thereabouts. People get very nervous about that. I would argue that that's not a disaster. China's economy has grown very rapidly in recent decades on the back of an export-led strategy, and if you've been to China, you know that it's one big building site. So they have generated a lot of growth simply by building, and if they build a little bit less, or let me phrase it correctly, if they increase construction a little bit less rapidly than they have in the past, then they will lower their growth rate, and it won't be a disaster for us because we don't really benefit from all that construction that's going on in China, at least not an awful lot. In fact, all that construction that's been going on in China has pushed up commodity prices, and that's been bad for us. In fact, I know that in the Netherlands is a big problem because copper prices are high, and people steal copper from the railroad lines, and then suddenly you're in the train and can't go any further because some bloody idiot has stolen the copper. And that's all thanks to the Chinese, basically. Although I think it's Dutch people stealing the copper, just to get that straight. But I think it's in the process of a soft landing, and I don't think it's necessarily a huge disaster for us. Let me quickly go back to the US. Just a couple of indicators that I find quite interesting in the US. I think what's happening there is it's reaching a phase of what one would call self-sustaining growth or even self-reinforcing growth. Just a couple of indicators. Over the top left is an index of business confidence of small businesses. Small businesses are the backbone of any economy. Business confidence in the recovery has risen everywhere, but in most countries, SME businesses have not done so well. But it looks to me if you look at this graph, confidence among small businesses is improving. Over here on the right, the top right, that's a confidence index of home builders. It's maybe even more important. Construction has been extremely depressed in the US for the last couple of years. This indicator, the NAHB index, was the first one to signal problems ahead for the US housing market, construction sector, back in 2005. And it's now starting to pick up. It's still historically at an extremely low level, but it's starting to pick up somewhat. And I look always for positives, and I have my hopes based on this graph when I say that I think home building will pick up in the course of this year and certainly next year. There's effectively going to be a construction boom in the US, depending, of course, on your definition of a boom. But they've cut home building levels by maybe 70% or so. So it's from that very low level. It's quite easy to push it up quite a bit, and I think that is extremely likely to happen over the next 2 years. You see something similar at the bottom left in car sales. Car sales are effectively at the strongest point since sometime in 2008, and all these things feed on each other. And then here we have consumer confidence with more or less a similar picture. But when I look at the US, I see the labor market improving. I see all these improvements generally. Of course, it's not a straight road. It's going to be a bumpy road. But my sense is the recovery is broadening, the base is strengthening, and it's becoming self-sustaining. So when I sort of summarize the economic situation, US looks good, Europe doesn't look so great, but will probably not have a recession, certainly, or we are in a recession, but we'll probably get out of that on the back of export growth to the rest of the world from the second quarter on. And emerging economies are benefiting from the stronger industrial cycle in the world. And also the policymakers in these countries have room to stimulate economic activity, and they're actually doing that. In a number of countries, you can clearly see that central banks are easing policy, and they have a lot of room to do that. Now, I'd like to move on to the euro crisis or problems. Let's downplay it a little bit. We had a crisis, now the crisis has become a problem. The stress levels in markets are now a lot lower than they were a couple of months ago. So what has happened? A number of things. You can probably make this list much longer, and I don't need to talk about all these things, of course. Maybe the bailout fund, the fourth bullet point here. This is sort of the safety net. the size of the bailout fund is likely to be increased. That's actually likely to be announced tomorrow. So that'll be hot. That'll be good because it will underpin confidence of market participants, I think. We have a new compact. To be honest with you, when they started to talk about a compact, I had to look up in the dictionary what that actually meant. But anyway, it means a treaty apparently. But they call it a compact for some reason. Maybe if there are linguists here, they can, after when we're finished, they can explain the difference to me. But we do have a new agreement on budget rules in the Eurozone that was signed a few weeks ago. It still has to be ratified, and I think it will help. Won't be decisive, but it will help to strengthen confidence in the whole thing. And the bullet point above that, the banks have now written off so much Greek debt that effectively they have very little left, which is painful. But the good news is it's behind us now. And I think even if Greece were to run into new problems, which they probably will actually, it won't be a problem for the financial system. Greece was a bit of a problem for the financial system, but not anymore, because there are very few private sector holders of Greek debt left, and whatever they have left is so small that even if they have to write it down to zero, it's not going to be an immediate danger to financial stability. In fact, the whole Greek problem has now become a European political issue. If Greece runs into more difficulties, then the European leaders will have to sort it out, and it's no longer a big danger to financial markets. But the most important thing that has happened in the last couple of months that has led to lower stress levels is, of course, my first bullet point here, what economists call the LTRO, the long-term refinancing operations by the European Central Bank. As any central bank always provides liquidity to the financial system. That's the way they have constructed the financial system, so that they can have control over short-term interest rates. So banks always borrow short-term money from central banks, and the ECB decided and announced in early January that they were going to supply 3-year liquidity at extremely low interest rates, currently 1%. The banks were invited to ask for as much money as they wanted. And instead of saying, well, we will then decide how much you get, they said, no, whatever you ask for, you get. Unbelievable. And do you know how much the banks asked for the first round? Well, it's a negligible amount of 489 billion. Then they did a second facility at the end of February, and they encouraged the banks to ask for more, and the banks did, and they asked for 529.5 billion. So altogether, the ECB has supplied 3-year liquidity to the financial system to the tune of 1 trillion euro. Pushing so much money into the system, has reduced stress levels. We're basically swimming in money. Now, I must say, I think it's great. Let me start there. It's fantastic, I think. But also, I have to say, it's a bit odd. They call it liquidity support. Imagine you have a good friend, and this friend rings you and says, well, I have a little bit of a liquidity issue here. And because it's a good friend, you say, well, no problem, I'm going to help you. What do you want? And the friend says, well, could I borrow 489 billion for 3 years? What you're going to say, well, you're saying no already. If it's a really good friend, you say, well, maybe we should sit down and talk. And you're going to ask that friend, are you really sure you have a liquidity problem here? This, of course, is semantics, but supplying money for 3 years, unlimited at 1% interest it's hard to label that liquidity support. That is more, let's do everything we can to keep the system on its feet. And in fact, we have to realize this. This is the most remarkable way of conducting monetary policy ever seen. ever seen. Honestly, I've studied monetary history. This is unbelievable stuff. In fact, I think it is fair to say that if you had asked 10 years ago, what will happen to a central banker who has the clever idea to supply 1 trillion of euros in 3-year liquidity support, or you ask what happens to a central banker who decides for the Bank of England to buy gilts, or for the US Federal Reserve to buy US treasuries and mortgage-backed securities and what have you, the answer you would have got 10 years ago would have been, that can't happen. And if it would happen, this central banker would be sacked and subsequently locked up. The only uncertainty is whether he'd be locked up in a prison or in a mental institution. And now we see all these things happening, and we cheer them on, actually. But we have to realize, this is really exceptional policy. This is exceptional policies. One of the effects, of course, if the central bank applies so much liquidity, or puts so much liquidity into the system, that money has to stay somewhere. And one area where it tends to go is banks get all this money, and they see, they borrow money at 1%. They see government bond yields, well, at this is Italian and Spanish government bond yields. Towards the end of last year, they reached 7%. This is 2-year yield, 2-year bonds. So if you're an Italian bank and you can borrow for 1%, and you can buy a government security of your own government, and it gives you a 7% yield, it's a no-brainer. You're just going to say, give me as much money as you have, and I'll buy these bonds. And of course, the result then is that you push down the yields as you push up the price for the bonds. You push down the yields, and everybody thinks that we've now solved this problem. An interesting element of this graph, I think, is that let's say if you take Spain now has, on their short-term paper, Spain has lower yields now than they did before the crisis escalated last year. I think that's a very good signal that the ECB has effectively caused a significant distortion in the system. Now, it's inevitable that would happen, but it is something we need to realize. This is the biggest distortion of financial markets ever seen. And distortions in markets are not necessarily always positive. So I think there's positives and there's negatives. One of the reasons why the ECB took such aggressive action is this. This is information coming from a quarterly survey that the ECB does among European banks. And one of the things they ask them in that survey is, what are you doing with lending criteria? Are you tightening lending criteria, or are you easing them? And when the line is high, the banks say that they're tightening them, and when the line is low, banks are saying that they're easing lending criteria. And you can see quite nicely, I think, that in 2007, towards the end of 2007, banks suddenly started to tighten lending criteria quite aggressively. That was an early signal that we were heading for trouble, that we were heading for a recession, which started in 2008 and then got a lot worse in 2008. And during 2008, we saw an unprecedented tightening of lending criteria. Basically, the economy was starved of credit. Things then improved. Okay, fine. In the second half of last year, we started to see a similar development. I think the most recent data that is here is for Q4. So this is from before the ECB pushed so much money into the system. But I think when the ECB saw this sort of data, they got very, very scared, and they decided, look, we're heading for the same as we experienced then. That's going to be a complete disaster. So we have to do something. So they decided to push so much liquidity into the system that banks would not feel the need to tighten lending criteria. So what we hope to see now is in Q1 and Q2 that this sort of reverses back again. But this is something they're watching quite closely. Now, there are all sorts of risks to the ECB's approach. The balance sheet of the ECB are probably not something you look at every day, but it has exploded, and it has exploded with assets that are of dubious quality. If the European crisis actually gets a lot worse, and let's say some more countries default, or actually the euro collapses, there's one thing you can be sure of: the ECB will go bankrupt. I can see you don't mind too much. That's okay. You don't see central banks going out of business very often, actually. So the question is, well, does it really matter if the ECB goes belly up? The answer is, well, it's a nuisance. What we need to do then is we need to recapitalize the ECB, and we'll do that. It's actually not a major issue. Of course, if you talk to a central banker, they'll say, oh, it's terrible, but in reality, it's much worse if we go bankrupt than if the ECB goes bankrupt. But that of course that speaks for itself. But it will give rise to turmoil in financial markets. Inflation must be ultimately a danger. I think I spoke about inflation maybe last time. Inflation now is falling. I don't think inflation is a near-term problem at all. But when you push so much liquidity into the system, then there must be a longer-term risk of inflation. I already mentioned that they're causing enormous distortion in financial markets, and that if you create so much distortion, that will lead to misallocation of resources. It's probably something we will have to live with. The biggest risk, I think, attached to the ECB policy is that the policymakers, the politicians, think, oh yeah, everything is quiet now. We have solved the crisis, and we don't need to do anything. And of course, that's completely wrong, because all the ECB has done is the ECB has won us time, and this time has to be used by the policymakers, the other policymakers, to sort out the real problems in terms of public finances and economic dynamism. So we have one time, and the other politicians must use that time to achieve structural improvements in the economy. The question then is, are we making any progress? Are we deleveraging? Are the public finances improving? Do we actually achieve structural reform in the European economies? Now I'm going to show you data for Spain and for Italy. I hope you can see it, but I'll tell you what it is. The top left is export performance by Spain on an index basis. And it compares, the yellow line is Spain, the green line is Germany. Of course, if you put it on an index, you always have all sorts of issues, But it makes it somewhat comparable. And the message that speaks from the top left panel is that Spanish exports are, believe it or not, starting from that arbitrarily chosen starting point at the beginning of 2008, Spanish exports are growing faster than German exports. So, that's encouraging, because we all think of Germany as this export powerhouse, and they are, but Spain is actually doing its bit. Things are improving. The result is that the current account of the balance of payments, which is the bottom left in Spain, they had huge deficits a few years ago. That deficit has narrowed very significantly. It's still a deficit, but it has improved an awful lot. The bottom right here is basically their budget deficit. They still have a deficit. It's still a challenge, but you can see, they have reduced their budget deficit quite a bit. And the top right I put in especially to amuse you. That compares Spanish export performance with that of the UK. With the green, this is exports to emerging Asia, which is the most rapidly growing region of the world, of course. The yellow line is Spain, and the green line is the UK. So we can have a laugh about how in the bad state that they're in, but in terms of their exports to emerging Asia, Spain is not doing a bad job. It's actually doing a lot better than the UK is. If you look at Italy, it's sort of a similar story. Its export performance is actually slightly worse than in Germany. That's on the top left. Then the top right is imports. Imports in Italy, of course, the economy is more depressed, so their imports are a lot weaker than German imports, which is actually good for Italy, because it means that whatever growth they have is not leaking away. And then the lower panels are parts of their budget. The one on the right is their overall budget deficit. You can also see, a very significant improvement. In fact, Italian public finances are in a pretty reasonable state. They have only a small deficit. They have a smaller budget deficit than, for example, the Netherlands does. And economists like to take numbers and then they take elements out of it, which is the bottom left panel. It is what we call the primary budget deficit. That is basically the budget deficit, but what we've taken out is interest payments. Like Italy has a large government debt. It needs to pay a lot of interest. It can't really influence that. So if you take that out, you get a picture of the resulting elements of the budget, which is what they can influence. And interestingly, Italy has for a very long time run a surplus on its primary budget, which is not what most countries do. Most countries run deficits. And the surplus is actually is now growing quite rapidly. Italy seems to be well on its way to sort out its problems. And in fact, they now have this technocratic government led by Mario Monti. The impression I get from Italian politicians, who have, of course, first got the country into a terrible state, they're now actually quite happy, is my reading. They're quite happy that Monti is doing the hard work and sorting out the stuff, and they go along with this, and then when Monti has the thing back on track, then they will be very happy to say, thank you, Mr. Monti, you can now retire, we take over from here. Different from the Greeks, where the Greek politicians seem to be quite keen to get their technocratic government out so that they can take over again. Why they would want to do that, I don't know. I mean, you must be almost suicidal or certainly masochistic to want to have the ambition to lead a country like Greece. But anyway, that's the situation. I think Italy is actually looking quite okay. And another thing that we need to do, of course, is deleveraging, and maybe I can move to the US, because I think there's something important happening here. This is a complicated chart, perhaps. It's basically debt levels as a percentage of GDP, and then it's divided into households, businesses, and the government, and it's, of course, gross debt levels. And what you see here is actually quite unusual. If you look at the green line, most people feel that U.S. consumers are overly indebted, and perhaps they are. It's very hard to say. Okay, it's easy to say for an individual whether he has too much debt or not, but for all consumers together, for all private households together in a country, it's very difficult to work out numerically how much debt can be sustained. Anyway, what has happened is over the years, this goes back to 1955, over the years there's been a trend increase in the indebtedness of US households, and in recent years there's been quite a sharp correction there, which I think is quite impressive, although I have to admit that 2/3 of this decline is caused by defaults. And not necessarily by paying off debt, but the rest is by paying off debt. But okay, so that is a little let's say qualification of it. But at least it's gone. It's gone. And it means that the balance sheets of private households are now healthier than they were a few years ago. And you see that in household behavior. Incomes in the US are rising, and US households are spending a reasonable part of the increase in their incomes on consumption. And that's good, because that keeps the economy going. If they're so seriously indebted that every dollar they earn more gets used to pay off debt, then the economy is dead in the water. When you look at the finances of households, I think it's looking okay. Of course, the price that they had to pay is this line. The government got leveraged up over the last couple of years, partly due to its policy response and partly as a result of the recession. I would think that the US government is still in an okay-ish position. It's not fantastic, but they're okay. Their debt levels are very high, but they're not hugely excessive. And I actually think that their budget problems are manageable. They have a budget deficit of 8.5%. They need to bring that down. They're not doing that this year. They'll start doing that next year. They don't need to bring that to 0. I think they need to bring that down to below 5. And what happens then is, because their nominal GDP is growing at a rate of about 5%, then this ratio can improve. Because if you have a deficit, on your budget, you need to borrow. That adds to the stock level. But we look here at a ratio. So if the level of GDP rises faster than the debt level, then obviously the ratio improves. So I think the U.S. Government's financial position is manageable. And you get all sorts of guys writing how terrible that is, and my advice is ignore them. Now, I do think there is reason for cautious optimism, but of course we can't close our eyes for all the uncertainties and risks that are out there. We could easily get, and we determined that earlier, a reasonable number of you think that it is quite likely that the euro crisis will flare up again. So that could happen for a number of reasons. Another danger is, let's say something nasty happens with Iran. Well, oil prices would shoot up, and if that happens, I can assure you that it'll be very, very detrimental to economic activity in the world. The economy is relatively vulnerable. Any serious rise in oil prices is going to hit us. Most econometric models say that won't happen, but from 30 years experience, I can tell you when oil prices go up 30%, certainly in a vulnerable environment, it is going to be bad for the economy. Borrowing costs could rise for a variety of reasons. Maybe we're wrong on China. Maybe China's not going to have a soft landing, but it's actually going to have a hard landing that, that won't be so nice. It is possible that European countries do too much austerity, and they'll basically squash whatever growth there is, or they may do too little, and financial markets will lose confidence. So European authorities have to find a fine balance there. So, and we can make this list an awful lot longer. There is a lot of uncertainties, and there's a lot of risks. But I think everybody knows that, and I think all these risks are effectively in the market. So if I move to the markets a little bit, maybe very, very simple. Price-earning ratios of equities. This is the PE ratio of the U.S. S&P 500. Just looking at the last 30 years or so, to us, equities look reasonable value. If earnings can be sustained, and we think they can, then equities actually look relatively, or look quite attractive on an absolute level relative to their own history, but even more so on a relative basis. If you compare valuation of equities to valuation of most segments of the bond market, wow, it's not even a contest. Equities look so much better than, let's say, German government bonds, or cash that yields very little. So I think from a relative valuation perspective, essentially equities look okay. If the economy doesn't go into a new downturn, then I think risky assets will do well. And I think there's so much fear in the market that there's still opportunities to benefit from that. It's the fear in the markets that has pushed the valuation levels to modest levels. Things have improved. Equity markets have already risen 25% or so. We think it won't be a straight line, but we think there's more in there. There's more to come. So what have we done in recent months? Well, towards in the fourth quarter last year, we decided that the situation looked extremely risky, and that there was every reason to reduce risk in investment portfolios. So we sold a lot of equities, and we bought safe assets, simply because we wanted to protect portfolios against the downside risk. In the event that wasn't really necessary, and as that gradually became obvious, we have rebuilt, let's say, risk exposure in portfolios. So we've made a couple of steps buying equities, and in our model portfolios we're now neutrally weighted. I think and I hope that we will continue that process, so that within the next couple of weeks or months we'll move to an overweight position. Within equities we have bought more cyclical exposure. We're also overweight emerging markets. I have to admit that we were overweight emerging markets last year, and that didn't do well, that actually cost a lot of money. But a lot of emerging markets have regained a lot of ground in the first few months of the year. So, and luckily we're still there, and we stay there. When you look at bond portfolios, the bond yields of core countries look very unattractive. German inflation, for example, is running just over 2%, and the yield on a 10-year government bond in Germany is also around 2%. Actually, it was below 2%. So you lend your money to the German government for 10 years, and they promise to pay you a negative return, and you still have lots of people buying it. You don't be one of them. Don't be one of them would be my advice. So in a bond portfolio, take a little bit more risk, but do it gradually. Buy corporate exposure, high yields, emerging market bonds. You get quite a reasonable yield pickup. Of course, the spreads have come in already quite a lot, but we think there's still value there. In terms of our geographical and sector allocation, this is where we are currently. I don't know whether you can read it actually, but basically it shows that we are overweight emerging markets, and we're overweight in terms of sector weightings. We're now overweight industrials, which is an expression of the cyclical exposure. And in terms of our bond portfolios, this is the current composition. So thank you very much.